The top 1% of Americans just hit a record. They now own 31.7% of all the wealth in the United States, the highest share ever recorded since the Federal Reserve started tracking this back in 1989. But that is not even the shocking part. The shocking part is that this top 1% holds roughly $55 trillion in assets, about the same amount as the bottom 90% of all Americans combined. Same economy, completely different planet. Forget GDP. Forget unemployment rates. Forget whatever the government tells you about the economy being strong and resilient. There is one letter that explains modern America better than any policy paper, any Federal Reserve statement, or any presidential speech. The letter K. Draw it out. Left side goes up. Right side splits into two strokes, one going up and one going down. That is the whole story right there. That is your economy. The top half goes up. Stocks, real estate prices, luxury travel, private jets, second homes, all climbing beautifully. The bottom half goes down. Rising rent, credit card debt, skipped doctor visits, food banks running out of supplies, all sinking quietly. And the terrifying thing is that both halves are happening at the exact same time, in the same country, on the same Tuesday afternoon. Back in 2020, deep in the chaos of the pandemic, an economist named Peter Atwater looked at the numbers and said something that nobody wanted to hear. This is not going to be a V-shaped recovery. It is not going to be a U. It is a K. Some things will bounce back, he said. Some will not recover at all. We thought about it. We probably should have thought a lot harder. Let us talk about the winners first, because the winners have had a very good 5 years. March 2020, the pandemic hits. Markets crash 34% in 33 days, the fastest stock market crash in Wall Street history. People are panic buying toilet paper. Executives are quietly selling their shares. And then the Federal Reserve did something it had never done at that scale before. It printed money. Enormous amounts of it, trillions of dollars. It cut interest rates down to basically zero. It bought bonds. It backstopped everything. The message to financial markets was clear. We have got you. Markets did not just recover. They exploded. The S&P 500 went from around 2,300 points to over 5,000 in just 4 years. If you had $100,000 sitting in an index fund in March 2020, you were looking at close to $220,000 by 2024. Congratulations, you did absolutely nothing. You just already had money. And here is the thing that nobody on financial news channels says out loud. The stock market is not the economy. It is a scoreboard for people who already own things. The top 10% of American households now account for nearly half of all consumer spending in the country, up from just 35% back in the mid-1990s. Half the economy, powered by 1/10 of the people. Luxury is booming everywhere you look. Airlines are ripping out economy class seats to install more business class pods. Hermes has a wait list years long. Private aviation grew 30% after the pandemic and never came back down. The top 20% of American consumers, those making roughly $175,000 or more per year, spent at a record high in 2025. A record high. While the rest of the country was clipping coupons. Now let us talk about everyone else, because this part of the story gets told a lot less often. Same pandemic, same stimulus checks, $1,200, then $600, then $1,400. Money in the bank account for maybe 1 week, maybe 2, depending on what broke that month. Then the checks stopped. Inflation did not. Rent went up 20, 30, even 40% in cities across America. Groceries went up. Gas went up. Car insurance went up. Everything just kept rising. And wages went up too, briefly, beautifully, for about 18 months in 2021 and 2022, when companies could not find workers fast enough. But that window closed. The bottom 80% of Americans spent at a record low in 2025. Their spending has not outpaced inflation in 6 years. 6 years. Not a bad quarter. Not a rough year. 6 full years of falling behind in real purchasing power every single month. McDonald's started reporting that lower-income customers were simply disappearing. Not moving to competitors, just going home. Chipotle, Cava, Dollar General, the whole fast food industry started quietly warning investors about what they called value-seeking behavior, which is corporate language for people can no longer afford us. The portion of United States GDP going to workers as wages and compensation fell to its lowest level in over 75 years of recorded history. 75 years. Think about what that covers. The post-war boom, the moon landing, the rise of the internet, every recession and every recovery since World War II. And workers have never gotten a smaller slice of the pie than right now. The economy grew, the pie got bigger, and somehow the slice for most people got thinner. Here is the part that should make all of us uncomfortable. The K-shaped economy has a dirty secret. It is hiding how bad things actually are. When analysts look at consumer spending data, they see a resilient American consumer. Spending is up. Growth is okay. No recession. Everything appears fine. But that number is an average, and averages can be deeply misleading. The top 10% are responsible for 49% of all consumer spending. That means the economy has become so lopsided that the richest Americans alone are responsible for nearly half the entire economy. And this creates an illusion. It makes the data look healthy even when most people are struggling. Think of it like a classroom with 10 students. 9 of them scored 0 on a test. 1 scored 100. The class average comes out to 10. The teacher reports that progress is being made. That is exactly how America's economy gets reported. Faithfully measured. Completely misleading. And here's where it gets even darker. Since 2005, households in the lowest income groups experienced price increases of 63 to 64%. Households in the highest income groups experienced price increases of only 56 to 57%. The poor do not just earn less, they also pay more for the same inflation because they rent instead of own, because they pay fees for being low-income customers, because their older cars burn more fuel, because their cheap processed food went up more in price than organic groceries. It is like being charged extra for being poor. Every single day. Meanwhile, the top 0.1%, not 1%, but 0.1%, now holds $24.89 trillion in wealth. Nearly 6 times the wealth held by the entire bottom 50% of Americans combined. 6 times. And that gap is not shrinking. It is not staying flat. It is accelerating. Now, forget the charts for a moment. Think about someone working 2 jobs in any major American city. A hospital worker by day and a rideshare driver on weekends, earning around $52,000 a year. 2 years ago, that felt like enough to get by. Not great, but manageable. Then rent went up $600 a month. Car insurance doubled. The grocery bill jumped 30%. The retirement savings got cashed out when the car broke down, and there was no other way to pay for it. That person is not recorded in any data as struggling. They show up as employed, full-time, contributing to GDP. They just cannot afford to live inside the economy they are helping to build. Now think about someone else in the same city working in finance earning $380,000 a year. Their investment portfolio grew by $200,000 last year without them lifting a finger. The market went up. The number went up. That is it. That person is not recorded as lucky. They show up in the data as evidence of economic resilience. Same city, same economy, completely different realities. The confidence gap between how the highest earners and lowest earners feel about their own financial situation grew to its widest point in more than a decade in 2025. They are not living in the same economy anymore. They just happen to share the same zip code. And this is not only a financial problem, it is becoming a political one. When the economy stops working for most people stop trusting the people who run it. And when trust breaks down at that scale, the consequences are usually messier than any recession. So what do we do with all of this? The K-shaped economy is not a temporary phase. It is not a post-pandemic blip that will correct itself in a year or two. It is becoming the permanent architecture of how the American economy operates. Luxury brands will continue to thrive. Dollar stores will continue to expand. Airlines will keep adding lie-flat beds and removing legroom. And economists will keep reporting resilient consumer spending while half the country quietly decides they can no longer believe in the economy they are being asked to participate in. There's a line that a poet named Percy Shelley wrote almost 200 years ago. The rich get richer, the poor get poorer. We made it to the age of artificial intelligence, real-time satellite data, and instant global communication. And the best summary we have is still a 200-year-old poem and a single letter of the alphabet. Maybe the economy is not broken. Maybe it is working exactly as it was designed to. An economy that calls half its citizens resilient and the other half a data point is not measuring prosperity. It is measuring who gets to define it.